Welcome to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the IBD Stock Analysis and editor of the IBD Extra newsletter. Tune in each week as we use history, not hunches, to help you stay safe in today's market and get in early on tomorrow's winning stocks. Now, here's Matthew Galgani.
Welcome, everyone, to another episode of How to Make Money in Stocks with Investors Business Daily. Amy, pretty soon here, you're going to be heading up to Portlandia.
I haven't been on the road for a while, so it's time for me to get back on the bus and travel. So join me in Portland for a leaderboard summit August the 8th.
And we also have other leaderboard summits in Seattle on August 1st and in San Diego on August 15th. And you can find out how to sign up for those at our website, investors.com/investingshow.
Okay, and this week on the show, we're going to talk about lessons learned from some great hedge fund managers, and these dovetail very nicely with CanSlim investing.
And we'll talk about how these lessons apply to Google, Netflix, NXP Semiconductors, and Skyworks in terms of some recent action from those stocks.
But first, let's take a look at the market. Well, we had some solid earnings reports this week, but the indexes have struggled. The market was in the red 4 days in a row this last week. The NASDAQ has held up a little bit better than the other indexes. We had the S&P drop below the 50-day. Of course, that index is more affected by the drop in commodities, which has hurt it. The Dow dropped below the 200-day. We've seen volume picking up, showing a lack of conviction by the pros. We have 7 distribution days on the S&P, which is a fairly hefty amount. We have 4 on the NASDAQ. And unfortunately, Matt, we're back to this yo-yo syndrome where, we head higher only to slump and lose ground again.
And this is one of those times where you want to pay close attention to the volume to see what clues it offers. And if you look at that run up on the NASDAQ to the new all-time high,
which looked exciting.
Wow, we're back at a new high. This is great. But if you look at the volume on that run-up on the upside compared to the volume recently now on the downside as it's pulled back from that high, it's higher on the downside. So that's not positive. It doesn't mean, again, that the market's not going to keep going up. I mean, who's going to try to predict at this point? It just keeps doing that roller coaster seesaw kind of action. But that is something you want to pay attention to.
Now, Under Armour zoomed before the open on Thursday. The athletic apparel maker beat forecasts. It had net income of $14.8 million, profits of 7 cents a share, and they raised their full-year sales forecast. And their NBA star Stephen Curry's signature shoes helped the footwear sales rise 40%. And, of course, the stock rocketed higher.
And one stock that did not rocket higher was Biogen. If you look at that stock, it got absolutely crushed. One of the reasons for that was that it dramatically cut its guidance, and it also reported that there was a failed clinical test for one of its drugs. And if you want to see what a change in trend looks like, go look at the chart for Biogen.
Now, GoPro soared. We had the earnings up 272%. Sales rose 72%. So the company is selling a lot of its wearable cameras. And the stock has made a nice recovery after, a pretty sharp sell-off starting in September of last year. Microsoft fell. It moves into the cloud computing business even more. They're transitioning from being a computer business. They spent $7.5 billion to acquire Nokia's mobile phone business.
As you're building your watch list for this earnings season, you have to keep in mind that this is very much a stock picker's market where you have to be very careful about what you buy and very careful about how you manage that stock once you buy it. Generally speaking, a strong earnings report has been rewarded, but a miss has been punished without question. So you have to be very careful about what you're jumping into. For example, look at Valiant Pharmaceuticals. It had a good report, it broke out, but now it's still trading right around the buy point, a little bit above it, but that's a later stage base. So you have to know what you're getting into, and if that trade doesn't work, make sure that you don't freeze and that you do get out of that stock.
Now, we also had Apple that disappointed on the iPhone sales. The stock sold off, but bounced back a little bit, then it saw more weakness on Friday. The floor for Apple's been around the $121 level, and the ceiling, or the area of resistance, has been around $133, but Apple's just had trouble making a whole lot of price progress now for several months. That's just the way that it's been. Chipotle Mexican Grill was higher. Their same-store sales were really good. Investors were concerned that the traffic wasn't as high. The traffic turned out to be just fine. Amazon, of course, was the darling of the week. The e-commerce giant really saw sales rise 20%, and they gave a bullish third quarter forecast of $24 billion versus $20 billion, which was expected. Visa also popped. We had Starbucks. That was another one. Their global same-store sales rose 7%.
And of course, next week, the earnings excitement continues. A lot of big names reporting next week. We have Taser, Facebook, MasterCard, NXP Semiconductors, Tableau Software, quite a number. And to see which stocks are scheduled to report, take a look at the earnings calendar, which you'll find in the Monday edition of IBD.
Yes, that's really helpful. And then after you take a look at the earnings calendar, do what Matt and I did in between recording the show here. We just flipped through a bunch of charts to see what's possibly setting up. And then we saw a couple. We said, oh, that stock is looking pretty bad. Like Virgin America, it's just going down, down, down. It's not setting up in a base. That's not to say they won't report maybe some good numbers. We're just saying some things that are potentially setting up in an area of price consolidation.
But as we've been saying for a few weeks now, you do want to be on your game during earnings season. There are still some stocks that are setting up and they're about to report. They could break out. But again, it's a tricky market, a lot of seesaw action, a lot of stalled breakouts. So be careful about what you get into and make sure you have a good game plan and you execute that game plan after you get in.
Imagine a Sunday morning, coffee in hand, you turn on your laptop or tablet, and you see a handful of stocks near a potential buying range. That's what you get with Leaderboard from IBD, a timely watch list put together by our market experts, and it's updated throughout the week with alerts to any buy or sell signals. The results? In 2013, Leaderboard has more than tripled the performance of the S&P 500. So to see what's on the list right now, get a free trial of Leaderboard at investors.com/radio show. That's investors.com/radio show. Now, back to how to make money in stocks with Investors Business Daily.
We're going to talk about some Market Wizard lessons, and these are found at the conclusion of Hedge Fund Market Wizards by Jack Schwager. And these lessons learned are from some great hedge fund managers, and it really goes right along with our method of investing because investors that have been successful in the market have several traits in common.
And one of the key traits is they practice risk management as well as have discipline. That is key to long-term success. And of course, they're very interrelated. They are tied to each other. And a lot of it comes down to process. And I had a boss back in Japan years ago who used to always say, good products come out of a good process. And I think that's very true. And do you watch The Prophet on CNBC?
Oh, he's tough.
Yeah, he is tough. Marcus Lemonis is the host of that, and he's great. And he's always talking about how you have to trust the process. And that's certainly true whether it's CAN-SLIM investing or another style of investing that you use. You have to commit to a strategy and then stick with that strategy. So the first thing that we're going to talk about today is one of the lessons from the Market Wizards book, and it says, don't confuse the concepts of winning and losing trades with good and bad trades.
And this can be tricky. So what that means is just because you made a winning trade doesn't necessarily mean it was a good trade. What do we mean by that? Did you break a bunch of rules? Did you get away with it? Well, that's not necessarily a good trade. You made money, good for you, but you broke some rules, and it won't work every time like that. On the other hand, if you had a losing trade, it doesn't mean that it was a bad trade, not at all. If you executed it because you had done your research and you found a great company with strong earnings and sales, and the stock broke out of a price consolidation or a base, and if it fell apart after that, don't beat yourself up because the trade didn't work out.
And we've been in a tougher market recently where you really do have to have good rules and stay disciplined. But if you go back to the roaring 90s where we had that great bull market and the dot-com boom, you could have picked not every stock, but it'd be pretty easy to find a stock that was heading up.
Oh, Matt, it was very easy to find stocks back then.
And you may confuse that, I've got this great investing genius, that's why I'm picking all the right stocks. No, a great market like that is going to lift most stocks up. So the key you have to remember is you want to create a routine and a process that is repeatable. It should be something that works consistently. But that doesn't mean it works every single time, but it should work a lot more than it doesn't work. So if you are buying or selling and you can't explain why you're doing that, what strategy, what rules are you following, if you can't explain that, then you're really just winging it and you're still in need of a process that you can rely on.
And you're going to run into trouble. You may get away with it for a while. If, let's say, we're in a really strong bull market, you might get away with just winging it. But, generally speaking, you have to learn what you're doing if you're going to be successful over the long run. All right, NXPI provides mixed signal and digital processing. And we're going to use this as an example of a stock that you might have bought, but eventually you might have run into trouble with it.
And it is an interesting company. NXP used to be called Philips Semiconductors, and together with Sony, they created Near Field Communications, or NFC. And that's the technology that lets devices talk to each other when they're in close proximity. So, for example, NXP's technology is used inside of Apple Pay and other mobile payment systems.
Now, NXPI broke out of a flat base May 27th. Here's one little clue that it might not have worked out, but this is not foolproof. Volume was 34% above average. Usually if you see volume 40% or more at the breakout, you have a greater likely that the stock will succeed. This was a little bit lighter than you'd like to see. And bigger volume means, of course, we see that buying power from the professional investors. It moved higher for a couple of days, and then it started to roll over. And unfortunately, pretty soon, you were 7% below the pivot, and that's one of our main sell rules in CanSlim. So if you'd bought the stock, you would have been knocked out at a loss. And you know what? Actually, it was good that you sold the stock because it continued to sell off. It fell all the way down to the 200-day line, so you did not execute a bad trade. It just didn't work out, and you're not going to be right all the time.
That is really worth repeating, and that is the idea: if you make a trade based on a sound strategy, sound rules, and it doesn't work out, don't beat yourself up. That's actually a good start, that you are using a system that's repeatable and it will work more times than it doesn't. And over the long term, that's how you build success. And one of the things that you're looking for before you jump into a stock is to look at the market conditions. And if you go back to May 27th and look at the Market Pulse Outlook that was in the big picture column that day, it said confirmed uptrend. So it's not a guarantee that a breakout is going to work, but it does tell you that the market environment is conducive to buying.
Now, you can see from a quick glance at the chart that NXP is a liquid stock with an average daily volume above 3 million. The sentence under the mini chart said that at that time, it was forming a flat base with a 10860 buy point. Now, one red flag might have been the 740% debt, which was pretty high.
And at that time, NXP was in the Your Weekly Review screen, and that's where the mini chart is that Amy was just referencing. And in that same area, you can see that NXP had a 99 composite rating. That's the best possible rating that tells you it's in the top 1% of all stocks in terms of both fundamental and technical strength. It also had a 95 EPS rating, a 96 relative strength rating, and it had an annual EPS growth rate of 56%. Plus, its accumulation distribution rating of B told you that there's been some institutional buying in that stock in the prior 13 weeks. So fundamentally and technically, NXP did have a lot of the traits that you look for.
All right, now another lesson from the Hedge Fund Market Wizards book is to wait for the high conviction trades. And for me, I'm not sure, Matt. I don't think NXP would have wowed me because something that I zero in on, as I've talked about all the time, is the volume. The breakout was a little bit tepid. I might have passed on this stock. And of course, as we said, shortly after the breakout, you saw a lot of pink volume days show up. Now, a real negative as a stock is trying to stage a technical breakout is that type of action. You really want to see it zoom out of that base on those great big blue volume spikes. Earnings had also slowed. This is kind of interesting. It had gone from 50%, the mid-50s, for a couple quarters, and they're down to 36 and 38%. The RS line had hit a peak as the stock was breaking out, but it too began to slump as the stock exhibited technical weakness.
And this really does get into the reality of investing in stocks. You're going to go through a buying checklist, hopefully check off most, if not all, of the things you're looking for, but there never is a perfect stock. And you have to take a lot of things into account as you're looking at that to see if it does fit what you're looking for and if it is a fairly high conviction trade for you or not. And certainly, as Amy mentioned, having really strong volume on the day of a breakout is a big plus. And doesn't mean that volume won't kick in later and the stock will go up, but again, you want as many things to line up as possible. So NXP is our example of a stock that looked pretty good, tried to break out, but ended up not working. Now, Ambarella is a good example of one that looked good and did work. If you go back to last August, Ambarella was on the IBD 50, and if you looked at the chart that accompanied that, you'll see that it also had strong ratings. It had a 99 composite rating, a 94 EPS rating, 95 relative strength rating. The return on equity was 25%, and the annual EPS growth rate was a very strong 41%.
The company designs chips used in high-definition cameras, such as those that are used for security cameras, as well as a variety of sports cameras, wearable cameras, flying cameras, and automotive video processing solutions. And Ambarella's chips are also used in many broadcast TV programs worldwide. On the mini chart, the sentence below said, the stock is climbing towards a 33-35 buy point after a failed breakout. So you knew that it had tried to break out at one point, failed, and it was heading back up towards that again. The accumulation distribution was a B-. One thing that caught my eye here, too, was the decrease in earnings. They were up 19%, but that's down from 44% in the previous quarter.
Again, there is no perfect stock. You have to take all those pieces together. And if you're talking about a slowing in quarterly earnings growth, that's obviously not ideal. You would absolutely like to have that going in the opposite direction. But take into account the other things that talk about earnings. For example, we just mentioned that Ambarella had a solid 94 EPS rating, and the annual EPS growth rate was 41%. So this wasn't the case of a stock that has no earnings. It had been slowing, but if you look at the overall picture, it was looking pretty good. And Ambarella did break out, and it made a huge move over the next several months. And as you like to see, it generally found support at the 10-week line as it made that move.
Now, a point that was made about high conviction trades is to have the patience to stay on the sidelines and do absolutely nothing until there's a good trading opportunity. You want to have your capital free enough so that when the opportunity in the market arises, you can buy a stock that really and truly meets your conviction list. And remember, the road to success is paved with mistakes, so in your post-analysis, you'll see why you bought a stock and how you could do better next time.
So next up, we want to take a look at another lesson from the Hedge Fund Market Wizards book by Jack Schwager. And this one may seem a little bit odd at first hearing, but it says, trade because of perceived opportunity, not out of the desire to make money. Of course, the whole purpose of doing this is to make money, so it may seem a little strange at first to hear that.
Yes, Matt, but you can be too anxious to do that, and we all can. In other words, you want to swing at the bat when it's a fat pitch. Now, some hedge fund managers in the book have admitted that they took risks, which they no longer do, and they put more money than was safe to do on margin. And in many cases, they ended up with losses, what they really shouldn't have had. So trading to make money is a bad idea. Now, I know everyone listening thinks that's just crazy, but you have to trade, of course, to make money, yes. But take a trade when the market provides an opportunity. And in this book, it says, as defined by their own individual strategy. And remember that all of the market wizards, whether it was stocks, commodities, currencies, whatever, all followed a methodology and they stuck to it.
And the bottom line is you want to keep your powder dry until you have something that's worth shooting at and you have a pretty good chance of hitting it. That's what's key. A lot of investors will just jump in because they want to be in the game. It's fun. It's exciting. They just want to be in the hunt. And the problem with that is a lot of times people will jump into a stock without checking the technicals and the fundamentals and the overall market conditions. Now, it's one thing if you're a swing trader or you're a day trader. That's a different story. But if you're going to follow IBD's CanSlim system, you need to choose your opportunities carefully. And if you don't, you may jump into a stock and then be sort of stuck in there if you don't have good sell rules and disciplines as something even better comes along.
And I do know some folks that always want to play in the market. I've run across them, from time to time. And it's almost like they need a leash to be pulled back from the edge of the cliff, They like the
bulldog for the market.
Yeah, they like the action that the market provides. They want to tinker around. And in Market Wizards, one of the traders mentioned having the discipline and the patience to do nothing when the environment isn't favorable is a really good trait to develop. Staying in cash during negative environments allows investors to sidestep a big drawdown during really harsh bear markets. So if the conditions are not right or if the return risk is not sufficiently favorable, don't do anything.
And you will have those times where if you don't do that, you end up regretting it because you'll jump into a stock and let's say it breaks out, but then it immediately pulls back and you're down 3, 4, 5%. And you really don't have any conviction in the stock because you didn't study the company ahead of time. You didn't really take into account the things that are key to look at. So now you're kind of stuck and maybe you're thinking, well, maybe I should get out. And in the meantime, something that is better and is starting to break comes along. And in theory, you could just get out of the stock you're in, move that cash into this one because you have a much better chance of making money in that better setup. But if you don't have rules getting in, you probably don't have rules for getting out either. So maybe you'll just sit there hoping that it's going to bounce back, and then your emotions start messing with you. You start to lose confidence. That's why it does just make sense to sit back, be disciplined, and wait for things to line up. When you have a really good opportunity, then jump into that. Don't just do it on a whim because it does come back to bite you. I can say that from personal experience. You have to be disciplined.
Netflix is a good example of waiting for a good setup and then going in once you saw that the choice you made was a good one. Netflix was rising higher ahead of the March 2009 new bull market. And if you go take a look at the chart of that, it was up several weeks in a row. Then it formed a cup with handle base, and from there it began to move. Now it did form another base before skyrocketing up 12 weeks in a row with only 2 down weeks during that time. And the breakout was on big earnings news, and big spikes in volume showed the conviction and buying power, giving investors the confidence to pick up some more shares.
Now, more recently, Netflix has had a very roller coaster type of ride. Just go look at the weekly chart for Netflix from 2014 through the first few months of this year. But then in April, it broke out very decisively. Netflix is not the perfect CanSlim stock. If you look at the earnings, the growth has been negative recently. Of course, we would prefer to see earnings growth rising ahead of a breakout. But that said, sales growth remains strong and subscriber growth has been very strong as they've been expanding internationally. Plus, just look at the volume on that breakout in April. It was massive. And if you consider the price of Netflix, that translates into massive dollars being spent on this company. It's a clear sign of big institutional demand. So going into a stock like that, you need to understand the flaws, the yellow flags about earnings and such. But if you're doing your homework on the company and you see the story behind those numbers and you see the volume that's going into it, it is something that you can get into as long as you do have sound sell rules and good portfolio management skills as well.
Now, I'm looking at a weekly chart here, Matt, and you're right. Netflix really had quite a ride, but there were some pretty deep bases along the way. Remember, we're talking about trade because of perceived opportunity. So out of these bases, what really made a big difference here, if you look at the huge moves, big weekly spikes coming out of bases happened as Netflix was reporting its earnings plus their future outlook. And that is what powered Netflix so high.
So to wrap up, keep these 2 points in mind from the Market Wizard's book. First, process is key. You must have a process that you can follow and repeat, something that you can rely on to be right consistently. Not every time, not every trade is going to work, but something that will help you make money over the long term. And number 2, focus on those high conviction trades. Don't buy on a whim. And of course, this sounds obvious and something we should all do, but it's just like exercising or dieting. Of course, we all know how to do it and what needs to get done. It's the doing of it and sticking to it that is tough. So don't beat yourself up, but do focus on following that process and making sure things are in place before you buy. The payoff is definitely there.
Successful investing starts with a successful strategy. Since 1998, the CanSlim investing system has been the top growth strategy according to an independent study of over 50 leading methods. How can you use the CanSlim system? Start with the How to Make Money in Stocks book series, which has sold over 2 million copies. See the rules, routines, and checklists you need to stay profitable and protected. Get your copies of the How to Make Money in Stocks series at investors.com/radio show. That's investors.com/radio show. Now, the final segment of How to Make Money in Stocks with Investors Business Daily.
So again, be sure to join me for the Leaderboard Summit in Portland, August the 8th. And we have several other workshops and Leaderboard Summits, and you can find access to those on our website at investors.com/investing show.
And the Leaderboard Summits are free, and you'll find those in August in Seattle and in San Diego, in addition to Portland.
See you next week, everybody.
You've been listening to How to Make Money in Stocks with Investors Business Daily, featuring Amy Smith and Matt Galgani. For more stock ideas and investing strategies, and to subscribe to the free podcast of this show, log on to investors.com/radio show. That's investors.com/radio show.